So with our disclosures on the screen, we'll take a couple of the questions that we received before this presentation started earlier in the week. They're both very good. The first question was what our take is on Meredith Whitney's appearance on 60 Minutes. So for those who are not familiar with Ms. Whitney, she was a banks analyst, a research analyst on the street, covering banks and brokers. And she's recently started her own firm that produces stock research, and wrote a piece on the municipal bond market, which we haven't actually seen or read, but we have seen her appearance on 60 Minutes. And she got on and talked about the long-term fiscal health of states and municipalities, and also made a prediction, which is the controversial bit. She made a prediction that there would be hundreds of billions of dollars worth of bonds that would default relatively soon because of the state of state finances. So I think that's what we'll focus on, and that's what we'll talk about. The first thing we'll say is that Ms. Whitney is not a muni bond analyst, and I think she's admitted as well that she's new to the municipal bond space, as is her firm. So we probably need to, get that sort of out of the way first. We, in general, feel this the statement about hundreds of billions of dollars in defaults is probably sensationalized. We don't think defaults are going to be anywhere close to that. We have seen a more recent estimate from Nouriel Roubini's firm that talks about $100 billion in municipal defaults over the next 5 years, and that seems to us to be a lot more reasonable. Defaults have been running somewhere around 10-15 billion every year for the past few years, and there's no reason to believe they're going to go up a great deal, though doubling is going up a great deal. The Roubini firm also estimates that recovery rates on muni bond defaults will be about 80%, and that's in line with historical default recovery rates. We do feel that in many cases recoveries will be smaller because we have seen bonds closely linked to the real estate space or certain geographic locations that have been hurt a great deal, and we think 80% recovery is going to be tough in those areas. Bonds that are backing subdivisions that were never built, where the only asset is raw land, for instance, that may not fetch the sort of prices it did in 2007 when the bonds were sold. So that sort of issuer and that type of bond could see great principal loss. But we don't see the type of large-scale defaults that Meredith Whitney seems to be suggesting. Hundreds of billions of dollars in defaults would be a significant portion of the muni bond market. We're talking over 10% of a $3 trillion dollar market if $300 billion worth of notional in munis defaults. And she seems to be the only person actually coming out with those sort of numbers. When looked at in the broader context, muni bond interest payments for the vast majority of issuers are maybe 4, maybe 6% of their annual budgets. So debt service, principal repayments as they come due, and interest payments are a relatively small portion of budgets for these issuers. And maintaining access to the municipal bond market is sufficiently important to them that we feel muni bonds will continue to see issuers pay principal and interest in a timely fashion. We feel there are very limited benefits to a muni issuer from by defaulting on bonds. There are certainly longer term concerns and issues that impact the long-term finances of many issuers. They revolve around pension liabilities that have accrued over decades, or healthcare liabilities towards retirees that have accrued over decades. And those definitely need to be tackled. But we don't see any immediate impact on budgets and finances. There were revenue shortfalls over the past few years during the financial crisis, and most municipalities and states accounted for them by or managed through the crisis with either some federal support or by tightening their belts, and we foresee that will be the case going forward as well. So we don't see the widespread defaults that Ms. Whitney is talking about. The second question we received is kind of related. It asks us about our view on the risks of widespread state bankruptcy. And we kind of touched on this earlier in the presentation. There is very limited benefit for a state to declare bankruptcy, and in a sense nobody's really sure what that would mean, because due to the federal nature of the US government, there is no provision for a state to declare bankruptcy. Typically an issuer or a debtor enters bankruptcy court petitioning some relief from creditors who may be seeking to collect on debts that the debtor is unable to pay. Now, because states are quasi-sovereign entities in the U.S. legal system, there's really no federal court that would hear presently a state that was looking for debt relief or bankruptcy relief in the traditional sense, nor has it ever been clear what reorganization would mean for a quasi-sovereign entity like a state. That's a concept that has been pretty effective in the corporate world, but we're not sure how that would apply to states. A little bit of history is probably useful as well. States have definitely defaulted in the past. So two significant periods are the period during and right after the Civil War, when the country went through a particularly severe economic recession, and then during the Great Depression, when there was environmental devastation across the Dust Bowl, Arkansas, and a number of issues in that state and others were either repudiated or debt service was stalled on them. Eventually some agreement was reached with creditors. During the Civil War, it tended to be Europeans who held bonds, and during the Great Depression it tended to be the big money centers, so New York, Philadelphia. In general, though, we think there's very limited benefits to states to declare bankruptcy or default on debt. And once again, we're not sure what bankruptcy means in the context of a U.S. state anyway. In most states, either their constitutions or other legal statutes place debt service at a very high priority when it comes to use of general revenues. Usually it's only after, let's say, paying for education So debtors are pretty high in the structure. And defaulting on debts would mean either state revenues suffered a calamitous decline on the order of 50, 60, 70%, or that you see a lot of new laws passed in individual states to repudiate debt or remove the special guarantees that debtors have, that creditors have on muni bonds issued by the state. And it's really difficult for us to see those sort of situations arise absent a far more calamitous series of events than we've seen in the past few years. We're not saying defaults are not going to happen. There are certainly weak issuers out there, and there's definitely many bonds that have defaulted over the past few years, and many that will over the next few years. They tend to be at the lower end of the scale. They tend already to be rated either junk or small issuers that are unrated. And we really do not see a large number of states and municipalities and localities defaulting on their debt in the foreseeable future, the next few years. All of that said, though, there are certainly risks, and that's part of the reason we've kept our portfolio so short. While we've been doing this presentation, we haven't received any additional questions. So with that, we'll wrap up and thank all of you for listening to us today, for joining us, and we will have a fresh presentation on a different topic next month. Thanks very much, and I hope you all have a great day.